Hello and welcome in everybody to this week's episode of the Magnify Wealth Podcast. I'm Cameron Gannon, here with my co-host Scott Gannon. Please make sure you like, subscribe, share with all your friends. Today what we're going to be talking about is uninterrupted compounding and why it's crucially important to never interrupt it, to keep that word uninterrupting involved with your compounding. So first of all, what is compounding? I'm gonna let Scott explain to you what that actually means.
Yeah, so compounding is essentially it's growth on top of growth. So for example, if you have $1,000, you earn 5%, you're at 1,050. Following year, the growth, if you maintain the 5% again, the growth will be on the 1,050. So in that scenario, it would be 5,250 in growth. Doesn't sound like a lot in the early years, but really what it does is it snowballs. So think of a compound growth curve is kind of like it teeters along, and then it just kind of hockey sticks upwards. So that, in order for that to happen the way we want it to, it needs to be uninterrupted.
Yeah, so why does it need to be uninterrupted? Well, let's look at a few ways you can interrupt it. First one, and probably I would say the most costly, is withdrawing your funds early. So if you're on your uninterrupted compounding curve and you decide, well, I need to dip into my savings for some sort of investment or a purchase like a car or a vacation. Well, this stops your money from growing during those critical years of compounding when it could have been really getting ahead. So what it does is it reverts you back to what a number you were in the past, and you're not losing the growth on the early years. What you're doing is you're losing the growth at the end of that curve, that very juicy reason we want to keep it uninterrupted. The next danger is market volatility. You want to take that one?
Yeah, sure. So market volatility is exactly what it sounds like. You get upside growth when markets are going up, but you just give it all back when markets go down. So, for instance, think of in terms of like a 50% drop. So, if you have $10,000 and it drops to $5,000. What do you need to earn just to get back to zero? And it's not 50, it's actually 100%. If you think of $5,000 has to double in order to get back to 10. So what really is the problem with interrupting your compounding is that the downside is always harder to recover from. When you protect the downside, it makes the upside way easier to accumulate and grow over time.
And just to add on to that, if it takes, say, 4 years to recover that downside, to get that 100% back, well, that's 4 years. You've hurt your compounding. It's taken from, again, the end of that compounding curve.
Yeah, I mean, it really is. It's not true compounding. It's just dancing along and, if you think of markets as in stock markets, I mean, obviously, history has shown us that they'll find their way up over time, but how much are you giving back or not participating in just by having to withstand the downside?
The next danger of interrupting your compounding is taxable events. So each time you have a taxable event with your money, that cash that has to be handed over to the government is not working for you anymore. You're interrupting the compounding on that amount of money. So this happens in lots of traditional investments, like say mutual funds. Each time you are taxed on those funds, you're not growing from the same amount anymore. It prevents exponential growth from occurring.
Yeah. So the biggest destroyer of our wealth is taxes, and if you can avoid them at any point and into whatever amount, if you can limit the taxable events in your life, your compounding is going to be that much better. And what we're talking about here is, the growth of your wealth. If you're sharing it with the government on a consistent basis, it will tremendously reduce the hockey stick effect of your compound growth curve.
And finally, the final danger would be poor savings discipline. So failing to contribute to being an honest banker is going to prevent you from experiencing the full growth of compounding because you're not continuously adding to the pile.
Yeah, I mean, that's, a savings discipline along these lines is essential.
Let's talk about the role infinite banking plays in participating in uninterrupted compounding. So first of all, what is infinite banking? Well, we do talk about this pretty well every week on here. Infinite banking is a strategy where we use specially designed high cash value, dividend paying whole life insurance policies to create personalized banking systems. And why is that a game changer when it comes to uninterrupted compounding? Well, first, you get guaranteed growth every single day. It's contractual. So that means the market volatility doesn't happen. It goes up every single day, so you don't get that downside. There's also no interruptions. So when you borrow against your policy, so you have use of the money, you're not actually withdrawing your funds. Your cash value continues to grow as if the money wasn't touched. It doesn't go backwards again in that scenario, so it grows, it compounds uninterrupted forever. And finally, we talked about savings discipline. Well, annual premiums are an advantage to ensuring that you stick to your plan. It keeps you being honest. So why don't you talk a little bit about the mechanics of the uninterrupted growth?
Yeah, so uninterrupted growth, well, I'll give a quick example here. I use a lot. If you had $50,000 of savings inside of your insurance policy, and on demand, of course, as we talk about all the time with our infinite banking policies, on demand, you order the money. It's not an actual application for a loan. So you order the money. Imagine the $50,000 is still growing at 5%. You take out $40,000 against the policy. You're borrowing the insurance company's money. Let's say you're investing that into, I don't know, whatever it is producing cash flow for you. That original 50,000 that you borrowed against is still growing at interest from 50,000, not 10 in that example. So if you're borrowing 40, you basically have $90,000 working for you. 50 inside, 40 outside, hence what we call multiply your wealth.
And the final advantage when it comes to compounding, when it comes to infinite banking, is on the tax side. So in Canada, life insurance policies allow tax sheltered growth. So your money compounds every single year without tax turning that dial down and preventing that extreme curve. We talked about many investments has that happened to them where you don't get uninterrupted compounding forever because the government needs their piece. Well, that is not a issue when it comes to infinite banking because you have tax sheltered growth.
So let's talk a little bit about. We're going to use an extreme example here of compounding. If you ever heard the penny example, if you saved a penny a day for 31 days, you'd have in excess of $10 million. In fact, almost 11. So about $10.7 million. Now, as you're plugging away with the penny example, and you get to say day 22, you got $20,000 in there, and you decide you want to buy a car. Well, or buy anything for that matter, or just spend the money. So you pull that 22 grand out. Well, what do you do? Now what? Well, now you're starting back with the penny. And a penny over the next however many days are left there, about 9 days, you're at about $2.56. So you're losing the absurdly amount of $10.7 million. And I know that sounds absurd, and it is, but it is an extreme example to make a point that compounding uninterrupted is imperative.
A good way to look at it is that first half of your growth is quite flat, and then you see it start spiking. But if you interrupt that growth, you're starting over on that flat part, so you don't get the chance to get the extreme effects of compounding.
Exactly.
So let's look at some tips for you for implementing uninterrupted compounding in your financial life. First one, start early. The earlier you start, the more time your money has to grow. And we use the example: when's the best time to plant a tree? 20 years ago. Second best time today. So the idea is, like I said, the longer you let your money compound, the more vertical, if you will, the graph will look by the end of it. So if you start today, you're going to see even more better results in the future than if you start in, say, 5 or 10 years from now.
Exactly. So it really is important to start right away. And of course, we as Canadians can benefit from using, as we talked about excessively here, is especially designed high cash value life insurance. Another useful one we like is a tax-free savings account, for the simple reason that it is never taxed. Now, is tax-free savings accounts always going to look like they are today? Probably not. But let's at least hope that whatever gets done today is grandfathered in. So so those are your two kind of key tax saving vehicles that that we're on board with. You want to take the next one?
Yeah, avoid emotional decisions. So stay disciplined in what you're doing. Planning is a long-term thing, especially when it comes to compounding. There's lots you can do in the short term to benefit you, but you need to avoid letting your emotions dictate that. Do a plan that allows flexibility, which infinite banking, of course, is.
When it's structured properly, for sure.
Exactly.
Yeah. So that's the final one, is explore infinite banking. If you're serious about uninterrupted compounding, infinite banking will help you get there, and it's important to use an authorized infinite banking practitioner that can coach you so that you do it correctly. Like Nelson Nash always says, is the best tool in the hands of somebody who doesn't know how to use it will not only produce unfavorable results, will likely break the tool. Well, in this case, the tool is your specially designed policy to implement the infinite banking concept. And if you don't use the right tool, as in build the structure properly, it's not going to work. You're going to break the tool.
Let's address a few questions before we let you guys go when it comes to compounding. First of all, does uninterrupted compounding mean I can never use my money? Of course not. We talked about with infinite banking, when set up properly, you can still access funds on demand when you need them, so that you can invest in opportunities or be ready for emergencies without interrupting the compounding inside the policy.
So another question is, what is the biggest threat to compounding? And of course, taxes and market volatility are two big ones. But taxes is truly your biggest wealth destroyer, and beyond that is actually the lost opportunity cost of these interruptions, if you will, in compounding. So the lost opportunity cost is the hidden threat that we talk about all the time, that nobody else wants to hear about because it's the unseen.
Finally, is infinite banking only for the wealthy? No, it's not. The wealthy are able to use existing cash to start a policy, but we can also do it with cash flow. We can use cash flow to start building policies. And if you're sitting there wondering, well, what cash flow do I have right now? We do help find cash that is getting away from you unnecessarily and or unknowingly, and use that to help build your asset. So, anything else you want to put on before we let the audience go?
Yeah, I'll just mention one thing. People that are with business owners, if you're incorporated or looking to become incorporated, there's some real value in knowing how to use this properly within your corporation, in that you can keep the money inside the corporation, so you only pay corporate tax before you build the program.
We do too. If you want to look down the list on our pods, there we have talked a lot more extensively on that subject, so you can do some exploring.
Yeah, and I mean, actually, I want to do this in a future podcast. There is a strategy around using your retained earnings kind of in reverse, but I'll leave that for another day.
Awesome. Well, thank you guys for joining us. Please leave a like, please share, please subscribe. Do it all. You might as well. Thanks for tuning in to this week's episode of the Magnify Wealth Podcast. Have a good one, guys.
Thanks, everybody.
Thanks for tuning in to the Magnify Wealth Podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.